The fortune disappeared. How did this happen? Parmalat grew fast. A small dairy in Parma became an industrial empire. Callisto Tanzi led the rise. He bought companies. He signed sponsorships. He bought headlines. Balance sheets gleamed. Revenues climbed. Share prices rose. The image was power. Inside the books was a different fact. Debt ballooned. Managers hid it. Shell companies multiplied. Offshore trusts sat like shadows. The decision was made. Keep growth, hide losses, issue bonds. Use financial engineering to mask cash shortfalls. The motive was clear. Keep the market calm. Keep suppliers paid. Keep stock high. That decision caused immediate momentum. Banks rolled loans. Rating agencies stayed quiet. Investors bought notes. Towns and townspeople prospered. Jobs stayed. Suppliers grew their invoices. The company became a town's pride. A factory worker laughed in a break room. A small supplier hired more staff. A retail investor watched dividends. Warnings came as facts. Cash positions looked odd. Subsidiaries had no clear purpose. Auditors flagged holes. Prospectuses repeated the same numbers. A striking claim appeared. A $4 billion deposit at Bank of America in the Cayman Islands. It underpinned the group's liquidity story. The document was presented with letterhead and signatures. No one verified the account properly. That was the first big risk. Another risk arrived in a strange invoice. A sales memo claimed milk shipments to Cuba in 55-gallon drums. The memo listed volumes that did not match production lines. Parmalat's plants filled cartons, trucks and pallets, not drums. Shipping records showed no containers. Experts flagged the unit mismatch. Forensic accountants circled the note. The 55-gallon detail looked ridiculous. It did not fit the company's supply chain. It smelled of invention. The warnings intensified. Bond covenants tightened. Bank officers asked for confirmations. Auditors asked for proof. The forged bank letter was resent. Suppliers demanded cash. A new decision was taken at headquarters. Double down on the facade. Produce more documents. Forge confirmations. Reassure investors. Momentum flipped to a crisis. In 2003, banks refused rollovers. One by one, lenders demanded to see the Bank of America account. Bank confirmations were requested. Bank of America said no such account existed. That single failed confirmation was the turning point. Investigators dug deeper. The 55-gallon memo was rechecked. Shipping manifests did not exist. The corporate web unraveled. A frantic consequence followed. Markets reacted. Credit lines froze. The company could not meet payments. The illusion collapsed. Auditors resigned. Regulators opened probes. The scale became clear. Roughly $14 billion of hidden debt. A forged $4 billion account had propped that illusion. Investors, banks, and suppliers faced sudden losses. Human lives changed in a night. 30,000 investors lost money. Suppliers were left unpaid. Factories shut. Families lost wages. An elderly investor saw her retirement vanish. A small supplier declared insolvency. A line worker watched the gates close. Courtrooms filled. The founder, Callisto Tanzi, faced trial. He was sentenced to 18 years. Some assets were recovered. Most losses were permanent. Investigators traced mechanics. Debt was shifted through holding companies. Fake bank confirmations replaced true ones. Letters used official seals, but bore forged signatures. Money flow maps showed circular loans that never settled. Forensic economists reconstructed what auditors missed. Liquidity numbers that contradicted cash flows. Red flags were there. They were small. They were ignored. New risk, offshore secrecy. New decision, complex legal structures. New consequence, verification failures. Each made the scheme harder to detect. At 3 points, a single document changed everything. First, the forged Bank of America letter. Second, the 55-gallon invoice. Third, missing shipping manifests. Each reveal led investigators to the next layer. At midpoint, act. Watch the full bank files in episode 2 to see the forged letters side by side. Trials followed. Executives were convicted. Some managers escaped charges. Regulators tightened rules in Italy and across Europe. Audit standards were revised. Banks improved confirmation procedures. Forensic auditing became a discipline. But gaps remained. Offshore opacity still helps conceal risk. Complex financial instruments still confuse non-experts. The human toll stayed. Pensions were smaller. Businesses folded. Communities lost identity. A supplier owner described sleepless nights counting unpaid bills. An ex-accountant said she had once raised concerns and was told to be quiet. A prosecutor held up the 55-gallon invoice in court and said it was the piece that made them ask the right questions. Forensic economics showed how the illusion was built. It revealed the steps: create circular loans, fake assets, and rely on slow verification. It showed the tools auditors needed: direct bank confirmations, supply chain reconciliation, and skeptical sampling. It taught 3 clear red flags: unexplained cash balances, mismatched units or logistics data, and repeated, unverified confirmations from opaque offshore entities. The lesson is not only about one man, it is about systems. Growth incentives can breed concealment. Audit routines can be lapped by clever forgery. Offshore secrecy can turn a local scandal into a global whole. The truth required cross-checks, prosecutors, and public pressure. New risk, complacent audits. New decision, stronger checks. New consequence, better protection for investors. Today, some reforms stand. Forensic teams work faster. Banks demand direct confirmations. Regulators force clearer disclosures. Yet the basic temptation remains: show growth, even if not real. The final image is a simple one: a redacted balance sheet, a list of reforms, faces of people who lost everything. The 55-gallon memo sits on a table, small and absurd, and it changed the course of an investigation. At the end, act. Learn the red flags. Share this story. This was not just a bad bet, it was a decade of choices. A forged $4 billion account hid a $14 billion hole. 30,000 people paid the price. The economy learned. The risk remains. Keep asking for verification. Keep watching the paper trail. Keep the checks tight.